welcome everybody to S Corp member call. It's been a while since we did one of these, and we wanted to go through the Biden plan, talk about what's in it, what's not in it, where it might be headed, and what we're going to do about it. So a couple of housekeeping items here to begin with. First, I know a lot of folks are wondering about the annual meeting and when our next board calls are. We are setting the next board call. It's going to be a call. It's not going to be an annual meeting on June 29th, Tuesday at 4 p.m. Eastern time. We are shooting to have people come into DC in September. We're hoping that by the time that September rolls around, the Capitol will be relatively open, the travel restrictions and that sorts of things will be minimal at best, and that we can have a normal meeting like we've done in the past. So we're shooting for Monday, September 20th through Wednesday, the 22nd. That the usual routine is that we'll have a welcome dinner on Monday, go through our business meeting and do the advocacy calls on the Tuesday, and then have a fundraiser and maybe a little golf on Wednesday. The annual meeting is open to all members of S Corp, as well as obviously the board members. So if you'd like to attend and never have in the past, please send us a note and we will send you the details. But that's what we're up to. Fingers crossed that all that works out and we're able to get people in town in September for a more normal advocacy operation as opposed to the virtual stuff that we've been doing recently. So for today's call, as I mentioned, we're going to review the Biden plan, discuss its outlook and prospects, talk about some action items that we're hoping that our members can engage in. If you have any questions, just go ahead and use the chat feature. Would be best, particularly during the presentation, if you have a question, and Alex will be monitoring that and he can jump in and ask anything that seems to be pertinent. And then at the end of the presentation, I think we'll open it up so that people can just ask questions directly. But during the presentation, use the chat feature, and then we'll have audio questions at the end of the presentation. So Biden has proposed a tax plan, and it's targeted at private businesses pass-throughs. What we're doing is characterizing it as a triple threat to the pass-through community, which means higher taxes on your business operations when you're in profits, higher taxes when you sell your business to fund your retirement, and then higher taxes when you want to pass your business on to your generation. Our view is that it takes the tax code to a place that it's never been before. Well, if Biden's plan were enacted, we would end up with high tax rates coupled with a broad tax base. We've had higher tax rates in the past, as we'll discuss, and I believe we've had a broader base, although I'm not sure about that. We've just never had a situation where you had really high rates coupled with a really broad base, and that's what's unique about what Biden has put on the table. In our view, it threatens the viability of individually and family-owned businesses. It literally is an existential threat, particularly to large family businesses that are subject not just to the higher rates, but also the changes to tax treatment of capital gains, particularly at death. So we'll talk about that. Higher taxes on operations. The first thing that they've done is propose to raise the top rates. So the top rate on income taxes would go from 37% to 39.6%. They would also do something that I don't think has gotten a lot of attention, and that is they would uniformly apply a 3.8% tax to all forms of income, regardless of its source. That's different than current law. Right now, there are a number of 3.8% taxes that apply to high incomes. There's the 3.8% Medicare tax that applies to wages and salaries. There's the 3.8% NIIT that applies to cap gains and dividends. There's the 3.8% SECA tax that applies to certain partnership income. But those 3.8%, they don't apply to all forms of income. So for instance, if you're a shareholder of an S corporation and you work at the business, so you're active at the business, you pay yourself a reasonable salary, any S corp profits beyond that You receive their taxed at the top rate, presumably 37% right now. They are not subject to the NIT, however. There's also, with regard to limited partnerships, I believe the same situation arises. So this policy that they put forward effectively would apply a uniform 3.8% tax to all forms of business. It would directly impact S corporations partnerships where the S corp owner or the partner is active in the business. So you have to add that on to the increase in the top rate, and the net effect is a 6.4 percentage point increase in the overall rate applied to pass-through businesses. So if you get the full 199 cap A deduction, then the top rate you're looking at is 35.5%. If you don't get the deduction, then you're all the way up at 43.4%. And that's just for the federal tax. That doesn't include the state tax. So once again, under Biden, they call it, they characterize it as a moderate or a modest plan. The fact is that we're going right back up to rates around 50% of what a business earns when they earn it. Obviously, these are rates that apply immediately. They're not like the corporate tax where it's divided between a tax that's immediate and then a tax that can be deferred. Second threat is on business sales. They want to raise the cap gains rate up to effectively the normal income tax rate, which would be 39.6, plus that 3.8% NIIT. So for incomes over $1 million, the top rate would be 43.4%. I'm not sure that we've had a cap gains rate that high, at least since the 1920s. So for almost 100 years, we have never had a cap gains rate that high. It would apply to taxpayers who earn $1 million, but that includes people who sell their business. And as you can see in the bullet here, a recent survey showed that about 1/3 of business owners, they plan to use their business sale as a means of financing their retirement. Well, oftentimes that business sale is going to push them above $1 million in income. They're going to be subject to this new 43.4% rate. It's going to take a significant part of the sale of this business. So you have somebody who starts a business, builds it up over their lifetime, and then they sell it when they're ready to retire. This is a big hit on their retirement plans, simply put. In fact, our friends at the Tax Foundation put together this very nice map that shows that when you couple the new tax under the Biden proposal with the existing cap gains rates that are applied by the states, you get some really, really high rates. So New York, it's 54%. California is the highest in the country, 56.7%. Washington State up there in the corner, they actually just passed a new capital gains rate of 7%. They still don't have an income tax, but they do now have a capital gains tax. So they're up over 50%. That's a significant hit, and it's going to have some impact. It's going to have a definite negative impact on the private business sector. Threat number 3 is what we've been referring to as the Biden double death tax. People characterize this as repeal of the stepped-up basis. It's not. It's worse. With regard to the Biden double death tax, what they're suggesting is first, they're going to apply this new cap gains at death proposal. And this would be this 43.4% cap gains rate, and they would apply it to any unrealized capital gains over $1 million in an estate. So if you have, an entrepreneur, they build up their estate, they die. What's going to happen is that while all these assets are in estate, they're going to deem that all of those assets are sold, and they're going to apply this new cap gains rate to any of the unrealized capital gains. Those same assets would then be subject to the traditional estate tax. What would happen is the value of the estate would be reduced by the cap gains tax that was just applied, and then they would apply the 40% estate tax on the remaining value. If you get the estate exemption of 11.7 million or 23.4 million with a spouse. But if you have a larger business that value exceeds that, you're looking at a total tax of over 60% on the combined taxes between the new cap gains at death provision and the old traditional estate tax provision. And again, our friends at the Tax Foundation did some numbers. You can see here, if you have an estate worth $100 million, all of it in unrealized gains. Let's say it's a business that started as nothing and has built up over value over somebody's lifetime. You get a 1 million exemption. You get the 1 million exemption from the cap gains provision. Then you apply the 43.4%. That means you're going to owe about $43 million in cap gains. You subtract that from the value of the estate, subtract the estate tax exemption, so that your new taxable estate number is 43 million, apply the 40% rate. You can see that results in an $18 million estate tax levy. You combine those two and you're up over 60%. Now, obviously this is an extreme example where you only have one spouse, you don't get the two exemptions, and the entire value of the estate is an unrealized cap gain. But nonetheless, the point is, if you get a large family business that where you are paying both ends of these taxes, you're going to have to buy back from the federal government a very large portion of that business every generation. It's going to have a material and negative effect on the ability of these businesses, not just to survive from one generation to the next, but to survive from one generation. When you know that this is coming, you have to prepare for it. You've got to set money aside. You've got to devote resources from the operation of the business, from investing in capital and workers. You're going to instead take that money and invest in second to die policies and or other planning and processes to try to mitigate or reduce the effect of this tax. I also think it's going to mean that a lot more private businesses are simply going to sell to a public company, because the public company obviously is not subject to this Biden double death tax. So one of the things that has been portrayed by the administration and the press is the idea that this is just a modest rollback of the Tax Cuts and Jobs Act. That, for instance, if you look at the corporate rate proposal, prior to the TCJA, the top corporate rate was 35%. It's now 21%. President Biden is proposing, let's just go back up to 28%. He's not suggesting that we raise the corporate rate all the way back up to 35%. What that ignores is the significant amount of base broadening that was included in the Tax Cuts and Jobs Act, as well as the base broadening that's included in the Biden plan. If you look at the corporate side of things, yeah, he's just going up to 28%, but he's also embracing all the base broadening that was part of the TCJA, including the 163J interest deductions and many, many other provisions, and a deduction cap, and many other provisions. And he's proposing his own base broadening, including significant rate hikes and base broadening on the international side. The net effect is that the tax on corporations, the effective rate, is going to go up way beyond what it was prior to the Tax Cuts and Jobs Act. The same thing applies, only more so, to the pass-through side, because unlike on the corporate side where you're only raising the rate halfway, on the pass-through side, as we discussed, the rate's going up to as high as it was before the TCJA and beyond. And the base broadening, I think you can argue, is even more significant on the pass-through side than it is on the corporate side. For instance, the NOL loss limitation rules, primarily those loss limitation rules primarily hit the pass-through sector. It's $140 billion rate hike that they projected under TCJA. The SALT deduction, it doesn't apply to C Corps, it does apply to pass-through businesses. That's something that we've been working a lot on in many states across the country. That's a huge revenue raiser. 199 manufacturing deduction was something that both sides would benefit from. And then the Section 212 repeal, particularly if you're an investment partnership or something, the repeal of those deductions was a significant hit to your bottom line. So this isn't a modest plan. It takes rates for pass-throughs up to well beyond where they were before, and it applies those really high rates onto a base that, as I said, it's about as broad as any tax base I've certainly seen. And then, of course, you've got the new base broadening proposals including the capping the value of charitable deductions, restoring the P's limitations, and other things that are part of the Biden plan. Just to give you an idea, oh, I'm sorry, no, we'll go to a different slide here. So one of the things that struck us when the Biden plan came out, when they announced it a couple Wednesdays ago, was the fact that 199 and estate tax proposals were not in there. They were part of the Biden campaign proposals, but they weren't actually in the plan that was released a couple weeks ago. We don't think that's a mistake, and we don't think we dodged a bullet, and allow me to explain. On the SALT front, what the administration has made clear is that they recognize that some sort of a SALT policy dealing with the SALT cap is likely to be part of the congressional discussions in any bill coming out of the House and the Senate. Members from the northeastern part of the country, as well as California, have made clear that they are going to insist on some sort of relief from the SALT cap if they're going to support a big tax bill this year. So they know that they have to address that in some fashion or another. But they've also made clear that they want to, they being the administration, that they want to have that SALT relief offset. And you can see from this distribution table here, the challenge with that is that most of the benefit for the SALT deduction relief comes for taxpayers making over $1 million a year. So if they're going to do anything on SALT, the distribution tables are going to be skewed towards your benefiting very high income earners. Well, so your offsets would presumably also want to target those same taxpayers. Well, what sort of offsets would those be? That's where we think 199 Cap A and the estate tax provisions will come in. That the Biden administration intentionally left those out to keep the focus on rates and rolling back some of the corporate relief, knowing that when Congress picks this ball up, they're going to want to do something on the SALT front, and they're going to need to offset that. And so they left those offsets available for them to use for that purpose. So even though it's not part of the plan, we fully expect 199 Cap A and estate tax changes to be part of the mix when Congress picks this ball up and runs with it. And we are tailoring our advocacy efforts to reflect that expectation. So what does it all mean? Well, it means fewer jobs. Our friends at the National Association of Manufacturers commissioned a very nice analysis by economists Diamond and Zudrow, who the bottom line is that they found that if you included all the provisions, the big headline provisions in the Biden plan, and this does include a rollback of 199 Cap A, along with a couple other things that we discussed, you're looking at 1 million lost jobs in the short term. You're looking at lower hours worked, you're looking at lower wages. Workers are going to suffer under the Biden plan. And as I discussed with that whole triple threat thing, private businesses in particular are going to be targeted by this. So that's the plan. That's the economic effect. One of the challenges we face with it is that all these ideas about taxing the wealthy, increasing the taxes on corporations and successful private businesses, they really appear to be based on what I think of as 3 faulty assumptions. And the first assumption here is that somehow over time the tax code has become less progressive. It's just simply not the case. One, the US has the most progressive tax code of all of our trading partners. And that reality has been validated by study after study over the last 20 years or so. 2, if you look at the changes that we've made in the tax code, every time we've done anything to reduce top rates or anything like that, we've always also included lower taxes for families with children, lower taxes for folks who are struggling. That includes the child credit, which we created back in the mid-90s. That credit started out as $500. It's now $2,000. It's now more refundable. It's now a place where most families making less than $50,000 or $60,000 actually don't owe any income taxes anymore. And this heat map, which I think is a very, very cool tool, the CBO, this is from the Congressional Budget Office. It gives you a nice visual demonstration of that increase in progressivity that we've seen over the last 30 or 40 years. You can see here, simple way to think of it is lighter colors are good and darker colors are bad. But the yellow part, the part where people are subject to marginal rates of 15% or less, it used to be 1 out of 4 families was taxed at those low rates. Now it's 3 out of 4 families are taxed at rates at that low or lower. You can see the white area has expanded over time as well. The other thing this shows, and we'll talk about this in a second, is you can see the really dark areas there. That's the part where people say, oh, well, we survived these really high rates in the past. You can see almost nobody paid those really, really high rates, like the little black area that I think you can see there, greater than 50% marginal rates. Almost nobody paid those rates. And in fact, the only time when people were subject to those rates in a significant way was back in the late 70s when we had very high levels of inflation and you had bracket creep, where the inflation was pushing taxpayers into these higher and higher brackets. They weren't really making more money per se, certainly not in real dollars, but because of inflation, they were, in the fact that the brackets weren't indexed for inflation, they were getting pushed into these high rates. That's the only time anybody of any significant numbers has been paying those high rates that everybody talks about. And it's also, if you recall, the time when the taxpayers revolted and we ended up with the Reagan Revolution and the Reagan tax cuts of 1981, and then subsequent to that, the Tax Reform Act of 1986. So again, the tax code, faulty assumption 1, the tax code is less progressive. No, not. It's much more progressive than, frankly, it's ever been. Faulty assumption number 2, Americans support high tax rates. Again, no, not. They do not support high tax rates. While there are lots of polls going around these days that say, oh, 60%, 70% of Americans support, the raising taxes on the wealthy, etc. What those polls never do is ask the voters, what's the most they actually should pay? What do you think is a reasonable amount for corporations, private businesses, wealthy individuals? What's the most they should pay? And what you find when you ask that question is the voters are actually very reasonable in what they think is the maximum rate that anybody should pay. We had the Winston Group ask this question a couple of years ago. And as you can see, even for wealthy individuals, which is not necessarily the nicest description, right? The maximum rate, and we did not suggest the rates, this is what they came up with on their own. The maximum rate that they thought was fair was right around 30, 31%. Public corporations, they thought 23% was good. Private businesses right around 20%. Well, the irony of that is wealthy individuals, public corporations, private, they all pay more than those numbers already. In other words, wealthy individuals already pay more than 31% of their income to the federal government. Public corporations, private companies, the same. Obviously, in certain circumstances, some companies might not pay a lot, but on average over time, they pay more than 23.4%. And that's the key here, is that this is not a challenge where the voters want really high rates on any of these taxpayers. It's a challenge where the voters don't understand what people are actually already paying. And so it's a communications challenge as opposed to a political challenge. And that's part of our agenda, is to make sure that people understand just how much taxpayers are already paying under the current rules. So faulty assumption number 3, that Americans thrived under high rates. I touched on this a little bit earlier, but the simple reality is that yes, we used to have statutory rates that were really, really high. So you can see this table here. They ranged all the way up to 91% for almost a decade, from 52 to 63. And then, they were still in the 70s all the way up to the Reagan Revolution of 81. Many commentators have pointed to those high rates and said, see, America not only survived those decades, you could argue that they were thriving in the 50s and 60s. The challenge with that observation is that nobody actually paid those rates. That back when the rates on individual income, ordinary income, were in the 90s or the 70s, wealthy taxpayers made sure that they never actually paid them. And the way they would do that is they would avoid taking salaries and wages, and they were subject to those high rates. And instead, they would have that income earned under a C Corp umbrella. or some sort of a business. And then they would make sure that they would load up the business with as many deductions as possible. And then they would make sure that they realized any income out of those businesses, either as cap gains or as corporate income. Obviously, the corporate rate was still very high at 52%. So the preference was to realize it as cap gains rate. The cap gains rate was 66 points less than the top individual rate at that time. So the game was shelter your income in a C Corp, make sure that you didn't take it out as corporate income, and then figure out a way to get the money out, usually in the form of cap gains at some point in the future. This dynamic creates a couple of things that I don't think are quite understood well enough. And one is that the reliance on the C Corp as the tax shelter of preference created a dynamic where the C Corps had a very large economic footprint, probably more than what they really deserved. And that changed dramatically after '86 when they fixed the rate differentials. So once they fixed the rate differentials and things leveled out a little bit, most people who had private companies immediately moved to S Corp structure, or they newly adopted the LLC structure, partnership structure, which makes much more sense. I mean, the rates were about the same, and at one point they were the same, but you just had a single layer of tax. You didn't have to deal with the double tax of the corporate sector. And all that income suddenly shifted into the individual side. That's a big part of why people think that the rich got richer over the last 34 years. Had nothing to do with the rich actually earning more money. It's just that all that income that was being sheltered and hidden in the C Corp structure was now showing up on individual tax returns. And I think Outen and Splinter have done a really good job. Economists have written several papers pointing out that dynamic, that much of this increase in wealth for the wealthy over the last perceived increase over the last 30 years is really just a shift in how that income is being reported. This is another way to think about it, which is, this is a really cool little map that shows, you can see these are the top rates that individuals would pay on their salaries and wages, the blue line, and it's all over the board. Meanwhile, if you look at the little green line, that is the income tax collected as measured against GDP. So the rates are all over the board. The revenue we collect through the income tax has been pretty rock solid, right around 8-9%. And it was 8-9% when the top rate was at 91%. It was 8-9% when the top rate was at 28%. It doesn't change. This is Hauser's law, I believe, and effectively what it shows is that income taxes, taxpayers will adjust their behavior, adjust how they earn income to minimize the tax, and they will figure out a way to make sure that they don't pay more than a certain level of tax. In Hauser's law, the fact that the actual revenues being collected don't adjust that much, despite the fact that the top rates were all over the board, is a really good example of that. So that's the Biden plan. That's the triple threat that it presents. It's got higher taxes when you make money, higher taxes when you sell your business, and higher taxes when you try to pass it on to your kids. It is an existential threat, and I think most people on the call are probably wondering, gee, I wonder where this is going. And here's what we see. One, since the Biden speech, we've noticed that there was a rather tepid response. There was not a lot of energy. There seems to be not a lot of clarity at exactly where the votes are at. That is, if they put forward certain policies, how many votes are there? If they put forward other policies, how many votes are there? I think they're going to have to spend a lot of time kind of just testing different types of approaches, different packages, to see which ones have the votes they need. And then there's also a lack of clarity on what the process would be. I mean, really, they have two choices in moving forward. One is regular order, in which they would need 60 votes in the Senate, which means they would need 10 Republicans to come over and join them. That would suggest a bipartisan process, much fewer tax hikes than what the Biden plan embraces, lower spending levels. There is a group of 20 out there that is working on a package that would have the support of 10 Republicans, 10 Democrats. That's the group of 20. And what they're talking about is a package in, the 600 billion to a trillion size, as opposed to the 2 to 4 trillion that's embraced under the Biden plan. So significantly smaller package. Obviously, the tax offsets in that package would be significantly less as well. If they don't do regular order, they have to go through reconciliation. That process isn't exactly clear either, because a lot of the spending that they want to do would not fit under reconciliation. So they couldn't do that. They'd have to adjust that package. They also probably need to adjust some of the tax provisions as well. I mean, we'll just have to see about that. But it's also with the recent ruling by the parliamentarian in the Senate, Elizabeth McDonough, that they can do multiple reconciliation bills simply by amending old budget resolutions. That also creates a level of uncertainty. Is okay, they could do one big package that includes everything, or they could do multiple packages. And now, there's confusion over exactly what the reconciliation process will look like. So the bottom line is, I don't think any of this has been worked through. There's still a great deal of uncertainty, not just as to where the votes are, what policies are going to attract how many votes, but also how the process is going to move forward, where they're going to end up. I think the base case is that they end up doing a single package, because it's a lot of work to put these things together, and we're talking trillion-dollar packages, even with a smaller package. They're going to need to have a lot of time, a lot of prep, a lot of work to get that done. There's just not time to do multiple packages like some people are envisioning. So I still think the base case, despite the parliamentarians' ruling, is one package. And then in terms of timing, Speaker Pelosi was looking for getting something out the door by the July 4th. That's looking highly improbable. We say improbable here, and it's highly improbable. We're probably looking at September, October at the very earliest. They're not going to put out some sort of big bill, have it publicized, talk about it, and then go away. They have a 6-week recess scheduled for August this year. They're not going to want that sitting out there for 6 weeks being analyzed, dissected. They're going to want to come in and have something that's fresh and move very quickly once they make it public. That means that September, October is the more likely time frame. There's still a lot of things that could get in the way of that time frame, frankly. There's increasing concern, frankly, of the deficits inflation. There's going to be a CPI report tomorrow. People are expecting it to be a pretty eye-grabbing number. There has not been a whole lot of concern over deficits for the last 10, 12, 13 years, certainly since we began doing all sorts of extraordinary central bank activities following the financial crisis back in 2007 and 2008. And I think one of the reasons that, even though we've been running up significant deficits and debt, there hasn't been that much attention is because inflation has never really been an issue. Well, it's possible that inflation is now going to be an issue. We're going to find out over the next few months. And certainly tomorrow will be a good indicator of that. So as inflation grows, I think that that's going to dial up concern over these deficits and the debt that we're running up here. The debt ceiling, that they have to deal with something. The current suspension of the debt ceiling expires on August 1st. They're going to have to raise the debt ceiling or pass some sort of responsive legislation. That's always a difficult vote, and this is going to be as difficult as it gets. So we'll have to see how they decide to handle that. I mentioned the group of 20. They continue to discuss. If they actually come up with a package that 10 Republicans and 10 Democrats are in support of, I believe that's going to dramatically change the dynamic and the outlook. It's going to be hard for particularly Democrats in the House to portray Republicans in the Senate as standing in the way of progress, et cetera, if there is a bipartisan package that's been agreed to and championed by a large bipartisan group of senators. It completely changes the political and the policy dynamic looking forward. And then, of course, there's a Manchin tracker out there. Joe Manchin has become the most powerful senator in the history of the institution. It seems like every issue kind of boils down to, what is Joe Manchin going to do? So if you want to see his latest pronouncements on all these things, there is a Twitter account, the Manchin Tracker. I highly recommend it. That in many respects, all these things are obviously important, but he is the one person, and to a lesser degree, I guess, Kristen Cinema, she's in a similar place. She's been less public about it, but really it just comes down to what they decide they're going to do. What are they going to support? What are they not going to support? Because with a 50-50 Senate, one person can stop Chuck Schumer from being able to get done what he wants to do. And right now that one person seems to be Joe Manchin, and as I said, in a similar fashion, Senator Sinema from Arizona. So that's the outlook. Summary. Biden plan raises taxes on owners when they earn money, when they sell the business, and when they pass it on to their kids. It's a triple whammy. This goes way beyond the Tax Cuts and Jobs Act. We're going to a new place with the income tax code that we have, higher rates and a broader base than we've ever contemplated before. It's based on faulty assumptions that I believe will be eventually rejected by the voters, and it means fewer jobs and lower wages. Action items for S Corp members. 1, be willing to tell your story. Once a week, twice a week, 3 times a week, I get reporters asking me for a business who can talk about a specific policy, like the estate taxes, like cap gains at death. We had the Wall Street Journal asking us for somebody last week or 2. We need to have folks that can step up and tell their story. And I know that it's not in the comfort zone of a lot of business owners to be public. But if you're not willing to defend and speak publicly about how these policies are going to affect your business, you're reducing the chances that we can actually defeat these policies. We need owners to step up and tell their story. 2, engage with lawmakers. Several of you have reached out to me and said, we'd love to either come to DC in person or virtually and talk to lawmakers on the Hill about our story. And we are going to take you up on that. We will be setting up meetings, calls, that sort of thing in the coming weeks so that you can do your direct advocacy, because that frankly is the most important thing that you can do. Attend our annual meeting. We're going to have it. I'm confident. Fingers crossed. I hope. If you can come, please come. Obviously, board members are the invited, but everybody else who's an S Corp member is also invited and welcome, and we'd love to have you come. And frankly, it's a great way to get to know other folks and network. We have some very, very smart tax experts who show up every year, and you can pick their brain because they're stuck there anyway. So please, if you have a thought about attending, it's going to be in September. The dates are on the slides here. Please let us know, and we'll make sure you get all the details. S Corp PAC. Fundraisers are starting again. I get invites all the time, not just for virtual fundraisers like we've been doing for the last year, but for real fundraisers where you sit down and you look somebody in the eye. And our PAC is a great way for us to make connections with new members, with our champions, or actively use it to create events that the other members of our trade association, members of the association, can come and use their PACs and tell their stories. So it's been a very, very helpful tool, and we need to make sure that we have enough money in there to make it work. And then membership. Obviously, this is a time when many businesses are fearful of the policies that are being considered here in DC. This is a very good time to talk about S Corp and build up the membership. Obviously, the more members we